So now let's move to our first speaker. Our first speaker is Richard Beales, Deputy Editor at Reuters Breaking Views. Richard's talk is entitled, So Far in 2017, 100 Days versus 140 Characters. And I have to ask Richard, did you count correctly? 100 days into the year? I don't really know.
I will
clarify
that.
Let you shed some light on this. May I ask you to come to the desk, and the floor is all yours.
Thank you very much, Kirsten. Afternoon, everyone. Thank you very much for having me. I'm Deputy Editor of Reuters Breaking Views. We are the financial commentary arm of Reuters, the news service. We are paid to report just like the news and build on that and have an opinion. So that's what I'm going to try and do. I should say, as we always do, these opinions are mine, not Reuters, or indeed any of my colleagues, although I'll be borrowing some of theirs. Now, So, there are various reasons I chose this title. One is that we are more or less at 100 days into the year, and we're somewhere midway between 100 days into the year and 100 days of the Trump administration, which always seems like a great time to take a little bit of stock, although obviously when we're writing and thinking about policy and stuff, you have to think much longer term than that. Next Saturday week is the Trump 100 days, so you can expect a heck of a lot of articles about that kind of thing in the following week. The reason for the other half of the title, of course, is this kind of thing. I think writers, journalists are having fun. It's difficult times in many ways. It's chaos and exhausting for the political writers among us. But I think business writers can have some fun with this. We've had tweets about companies, may or may not move the stock price, tweets about jobs being created, tweets about stocks being up, and we should thank the administration for that. And then some other ones. I have one example of one of the more older tweets that sort of look a bit different in current circumstances about the Gulf just there. But this is been part and parcel of these first nearly 100 days of the administration, is we're trying to figure out, like everybody else, what the right view to have, how to think about the things that are happening and are not happening. And we do the same thing every year, a little bit earlier. And I have it here to wave at you. The Slim volume was our book of 2017 predictions. We produce that very early in January every year. And we try to include some interesting thoughts on lots of kinds of topics. I used to be actually an infrastructure and M&A banker, so I take a particular interest in some of those areas, but we write and edit about all these things and more. Even one of the lighter topics in the book, I'm not going to talk about it, but it seemed appropriate on this day, which is 4/20, the high holiday for marijuana lovers, is a piece about the active ingredient in magic mushrooms, which apparently has a lot of medical potential. In any event, I ran a word cloud on our predictions book, and not surprisingly, even though we try to cover the world, we focus on finance, but also economics, all kinds of things, the biggest word in the whole book for pretty much everywhere in the world in the beginning of the year, because we did this after the election, but before the inauguration, was Donald Trump, of course. So we also want to try and now take some stock of our predictions as well. So the first thing, these are going to be my four broad areas of this discussion. As long as we get through it, one thing I can't quite predict is how long this will take, especially with the polls, so we'll see how we get on. We heard a lot about the Trump bump, about animal spirits, about the potential for business-friendly policy, lower taxes, less regulation. And this is what happened after the election. These are 6-month charts of the S&P stock index on the left and the 10-year yield on the right. And so the big bounce on the left-hand side of each is obviously the election. And the bump for these US benchmarks, at least, particularly stocks, has held up pretty well. The yield is coming down a bit. I mean, it's never quite clear what's driving these things, of course, but one interpretation is everybody heard a lot, saw a lot, thought this was going to happen, thought businesses were going to do great from this administration, then some of that optimism is fading a little bit. That's one explanation. I don't know if that's right. But what do you guys think? So this is going to be the next poll, if we could do the next poll. We already got some answers. Excellent. Is this going to go up? Yes. Interesting. All right, so less likely, I think, seems to be winning the day. I think the interesting thing about that is if it's less likely you get the good stuff, it's also less likely you get the bad stuff. At least that would be my assessment of it. Okay, so I think we're getting at 80, we're probably getting to a quorum. So I think what we see there is maybe that reflects that simple interpretation of those numbers a little bit. I think there was a great deal of, I heard a lot about animal spirits. I read a lot about animal spirits in the business world, and I haven't read so much about that, or been inclined to write so much about that recently, because it seems it's a struggle for the administration to work with Congress in a way that gets done what it wants to get done. We'll see. It's 100 days is by no means the end of it, of course. Okay, can we switch back? This was our prediction on this particular issue, that this Trump bump might not last. As I said, I always felt that if Trump could get the business-friendly stuff done, he could also get the less business-friendly stuff done, the barriers to trade and so on. So it was never quite clear to me why many business people seemed to think that only the good things were going to happen. So I've got another one for you right away, and this is a longer-term look. So at the end of the Trump's first term, at the end of 4 years, where do you guys think the economy will be sort of generalized? Growth, employment, and inflation all put together. Can we run the next poll? Interesting. So either about the same, steady growth, steady improvement, or weaker, but not stronger. We're not great believers in 3.5%, 4% growth in this room, it seems like. Okay, can we switch back? That's great, thank you. So our prediction here, and actually one from the previous year, which we included because the election was coming, was that recession probably awaits the next president. There was some thinking behind that, and and in the first one, that if he does manage some stimulus, it may only delay that outcome. Here's one reason why. If my colleagues' calculations are right, and I'm confident they are, the average period from the end of one recession to the start of the next recession since the Great Depression has been about 5 years, and the maximum period of not in a recession in that time, in fact, in much longer than that, has been 10 years, and we will get to that 10-year point in June 2019. So unless it's going to be a record period of growth, which is not impossible, especially since it hasn't been that strong, but if it's not going to be a record, there'll be a recession by the middle of 2019, just to cheer you all up. Okay, I did want to touch a little on the emerging markets, or indeed the rest of the world altogether, not just the US. I included a couple of things from this week that we didn't predict. Actually, I'm not sure we tried to predict these, but we certainly didn't predict them. We got slightly improved growth figures, at least, from China, and improved forecasts from the IMF too, although with some caveats. I do have the numbers lying around somewhere. We can maybe talk about them later if anybody wants to, but it's interesting that Japan, Europe, all upgraded very slightly by the IMF. World growth upgraded. Activity looking a little bit stronger in China as well, and that's all external factors that obviously impact the US economy too. And it's slightly aside from the trade question, because the IMF, for one, has warned that the trade, protectionism is one of the big risks to their forecast. So we shall see whether any of those measures that Trump and his colleagues have talked about end up happening. Just a couple of indicators of what markets at least think about the rest of the world. Now, these are one-year charts, just so everyone can see where these were before the election. So the big move in the middle of these charts is the election. So on the left is the JP Morgan MB Global Core Bond Price Index. So these are emerging market bonds. They fell out of bed with the election, and I assume the thinking there was trade concerns, openness concerns, primarily driving that. They've recovered back to where they were basically before the election. And then on the right, this was for a little while the classic indication of what people thought about Donald Trump's chances of winning, and then right after the election, the chances of him implementing trade restrictions, especially with Mexico. This was the peso, of course, totally crashed, both a little bit before and after the election. Actually recovered now most of that ground. All these charts are a couple of days out of date, but I checked this morning and nothing has changed a whole lot. So there you have, the peso was, at least for a while, this kind of very volatile little indicator. Every time Trump said something about Mexico, it would move in one way or the other. And, it seems like the fears about that border being basically closed, which was almost the rhetoric at one point, those seem to have dissipated more or less entirely. Of course, there are lots of risks. The IMF mentioned protectionism. We have geopolitical risk. We have North Korea. We have the actual event of Brexit a couple of years down the line and everything that might happen there. We have elections in France starting on Sunday. There are many things that can upset growth and upset the balance. But it's interesting that a lot of, your answers too to some of the questions suggest there'll be much more the status quo than most of us thought. A quick poll now, please, on, again, very general, where, and I've just put developed market and emerging market, stocks and bonds. If you had to guess, if you had to put $500 in something for a competition for the next 12 months, which of those asset classes would you choose? Can we run that poll? Thanks. That's interesting. That would be something maybe we should talk about later. It's and they haven't done too badly anyway, emerging market stocks. It's interesting that you're not all Warren Buffetts and believers in the US stock market. Great, thank you, if we can switch back. I hope we can get copies of these so that we can refer back if we want to when we're talking about this. Okay, so my third section is infrastructure and investment. this is skating over a huge area in very few slides, but here was one of our predictions, which was that you have both the need and a sort of political and policy pressures for investment in infrastructure really around the world. Japan has its own reasons, Europe and the UK have their own reasons, and the US, this appeared to be at least a bipartisan mission that people could get behind. And one of our arguments in our predictions book was this chart on the right, that the levels of investment relative to GDP have been going pretty much steadily downward over quite a while. And anecdotally, as the president has pointed out, the infrastructure and certainly around New York could do with some fixing. That does suggest it's needed, but we haven't heard a ton about this issue since the inauguration. The last paper that I'm aware of came out in October from a couple of Donald Trump's advisors. And we've heard a little rumblings, and different people seem to have different views on how to pursue it. I hope we'll hear more before long, but we got another poll for you on infrastructure spending in the US, coming right up, if we can switch to that one. So this is by about a year from now. What kind of level of infrastructure spending or policy do you expect to see? Now, Trump's plan, I should point out, the one that was made public, the one by Wilbur Ross and Peter Navarro back in October, was what's now the second one, the legislation. He talked about $1 trillion, but it was really mobilizing private investment, not actual government money. That's pretty depressing. So a narrow win for getting nothing done in this area. It's kind of depressing. Okay, that's really interesting too. Good, well, if we can switch back, that would be great. These were a couple of our predictions on this topic. Not predictions, actually, these came subsequently. I shouldn't pretend they were predictions. I had a good look, a deep dive in the plan, and actually had an interesting panel discussion about it a few months ago as well. It's not clear it's even necessary. It kind of makes it cheaper to finance projects that are viable, and projects that are viable kind of probably don't need subsidies and help, tax subsidies and help. It's really other kinds of projects that might need the help, and we don't yet know what those are going to be. But the second piece there is more about that. Gary Cohn from Goldman, it seems to be taking some grip on this issue and trying to figure out what would be the best thing to try to get done. Now, I knew Coface back in the day when I was a banker, when it was big part of the French export credit setup, and we've also written about Export-Import Bank a little bit, and how it's interesting, and Trump's own messages on this in the last week or so have been very mixed. But we felt, it's a good national champion kind of support, and he seems to believe in those, and yet the Republicans in Congress, it's a big bugbear of theirs. They don't want it, at least a lot of them don't want it. So it'll be interesting to see how that plays out as well. More globally, I've always had some doubts as to whether, Japan is spending on infrastructure, spending on a lot of things, but I don't see a reason why they would spend more. I'm not sure Europe is going to spend a ton more, and I'm not sure the UK has the money to spend a ton more, and I'm not sure it's going to get done in the US either, and clearly you're not. So it's interesting, it'll be interesting to see how that plays out, whether the infrastructure spending that people seem to be expecting does come to pass or not. Just to turn briefly to, because I like this chart and because I think this is a great topic as well, this is corporate investment. And we've had a lot of discussion that, and this is something you could do even not being able to do a fully fledged package of tax reforms. Something that's been done before is an amnesty for offshore cash, and that's the context in which we wrote this prediction. basically saying, the promise of this idea that companies whose cash is trapped overseas, because if they bring it back to the US, they suddenly have to pay tax on it, that if you give them an amnesty, they bring it all back and they invest in jobs and factories and so on and so forth. We just don't think that's right. The CapEx, job spending, factory spending is not constrained by supply of funds. As you can see from here, there have been more and more share buybacks and dividends and acquisitions. There's plenty of money if there was that investment to be made productively. And in fact, the proportion of those shareholder returns versus the investment in the business has been going up. And that it's clear, and this was very much the case last time this was done as well, that if that did happen, a lot of that cash would flow back to investors, which is great for investors, potentially good for stocks, but isn't necessarily a job-creating mechanism that it's often claimed to be. So I wanted to just do a sort of grab bag of other topics that I think are interesting, and I'm going to ask you about them first. So we have 5 minutes left. That should be just about right. And that is the next poll, the last poll. So which of these issues, for good or bad, has the most potential to change the global economy and markets in the next 10 to 20 years? Fascinating. So I think it was Stephen Mnuchin, the Treasury Secretary, who said that we don't need to worry about robots and AI just yet. Okay, that's fantastic. That's an interesting group. I'm not really going to talk. I'm going to skip autonomous vehicles, which was very short anyway. Can we switch back to the presentation? Thank you. How do I go back? Just wanted to go back to this one. Just a couple of consequences of protectionism if it happens. One is this is one of our predictions. We cover a lot of M&A. And outbound Chinese M&A has been a big factor, or Chinese buyers. If they haven't been the buyers, they've been the stalking horses and pushed prices up. And we felt that this could be one of the big casualties. I think you see it in US reviews of whether the Chinese should be allowed to buy things. That's one factor. The Chinese are worried about capital outflows. That's another factor. This could be an interesting impact on the M&A market. As for robots, I think, certainly my colleague who wrote this, I think I agree, is that globalization, it's not about borders, it's actually much more about these changes, which are not something you can address. Even if it worked to close your borders, it's not something that solves the problem here. I had a quick one there. I'm going to skip over it. I just want to talk for a minute about this as well, partly because I had the great good fortune to take a trip to Antarctica in March, which I would highly recommend because it's the most amazing place. But there's also been a lot of climate policy initiatives, or at least executive orders, and we may see changes in how the US government addresses these things. I also had a really interesting discussion yesterday with a group of investors interested in environmental, social governance, those kinds of things. And they mostly actually seem to agree with the heading of this piece I wrote last month, which is that it's a little too late for the changes in federal policy, assuming they really happen, to have a great deal of impact. Obviously not good if you think we should be trying to reduce impact on the climate and the world. But there's a bunch of reasons why. One is a lot of regulation is driven not by the federal government, by the state governments, including two big ones, California and New York. And obviously they're huge. And you can't sell cars in the US if you can't sell them in California, and that's been a big driver of car emission standards. There are basic market forces. The renewable energy is competitive now, certain kinds, utility scale solar and wind power are competitive on their own right. And companies and the investors in those companies are demanding attention to these issues as well. And of course, it's not just a US concern. There are other countries driving this. So if you want to operate around the world as a business, you have to address all of those. So we'll see. We'll see what happens. It's also Earth Day on Saturday, so that was another reason to talk about this. My last anniversary date that I was going to mention. A tiny slide about breaking views. You can look it up when you download the presentation. If you're interested in trying our service, trials are available. You can log in. And if you have the Reuters service already, you can find us there. Thank you very much.